rising stock market set another record with the Dow Jones Industrial Average passing 12,000 for the first time at the New York Stock Exchange. October has never been the stock market's favorite month. The crashes of 1929 and 1987 took place in October. But this year, fueled by lower oil prices and the prospect of an end to 2 years of interest rate increases, the Dow Industrials have put on 350 points in this October. The milestone came on a day when the Labor Department reported consumer price inflation easing, while at several key companies, third quarter earnings were up smartly.
We've had a 25% pullback in crude oil prices. We've had lessened geopolitical tensions with an end to the Israeli-Hezbollah conflict in the Middle East. We've had more benign inflation data. The Federal Reserve is now seen as being on hold, whereas before they were aggressively raising interest rates. And all this is leading to more confidence in a soft landing for the U.S. and global economies.
Oh, by the way, subprime of the actual lending thing is completely meaningless. I am now saying that if every loan in 2006 that was subprime blew up 500 billion, if they all blew up, it you would still not notice.
It was the Fed to the rescue on Wall Street after 6 straight days of losses. News that the Fed was cutting its key discount rate put investors in a buying mood. At one point, the Dow jumped more than 300 points before settling back a bit. At the closing bell, the Dow surged 233 points. The Nasdaq was up 53 points in the session. In its latest move to ease the credit crunch that has been roiling the markets, the Fed cut its discount rate by half a point to 5.75%.
What goes up must come down. At least that seems to be the case on Wall Street. After a string of up days earlier this week, the Dow erased it all and ended up down in negative 400 plus territory for a second straight day. A slew of yet more bad economic news traumatized the markets.
We got unemployment. Unemployment's the highest in 25 years. 3.5 million Americans collecting unemployment. Not a great sign considering tomorrow we get non-farm payrolls.
The signs were everywhere, but now it's official. We are in a recession. The research group that makes that determination made it today and said the recession actually started a year ago. But the question now, when will it end? Wall Street is clearly worried. The Dow plunged nearly 680 points today, or 7.7%. Anthony Mason is our business correspondent. Anthony, last week's big rally is now just a fond memory, isn't it?
What the market giveth, the market also taketh away, Katie. Remember that historic 5-day rally, the biggest since 1933? Well, it ran into a bear today, and in one big bite, more than half of those gains were gone.
You knew what the banks were doing, and yet we're touting it for months and months. The entire network was. And so now to pretend that this was some sort of crazy once-in-a-lifetime tsunami that nobody could have seen coming is disingenuous at best and criminal at worst.
Based on what we heard today, the Fed is now a little more worried about a slowdown than it is about inflation. And the averages reacted appropriately to that change, with the Dow gaining 512 points to a new all-time high, S&P jumping 1.37%, NASDAQ climbing 1.38%, a little more tepid than the others. Yes, when Fed Chief Jay Powell says the economy has slowed considerably, that's good news, not bad. It means that the Fed's now on the side of those who own stocks, not the ones who don't own any. Not only is the Fed no longer our enemy, it's much more likely to become our pal, assuming the economy stays on its current slower course. This is the about face that the bulls were waiting for. It's the comeuppance for the myriad bears who never embraced the possibility that Powell could engineer a soft landing, a terrific soft landing.
It doesn't sound the same, but it sure as hell rhymes, doesn't it, folks? Welcome to, again, Financial Fitness presented by Patrick. I am, as always, Patrick. And that just more or less sums up exactly where we are in the markets right now. The first half of that presentation that was brought to you by the Maverick of Wall Street. Shout out to this guy. Awesome analyst. Great information, what he's putting out there right now. It's the same. It's exactly where we were in 2008, 2009, and it's where we are today. Almost to the geopolitical crisis that are named. We have tonight, I'm doing this at about 1 a.m. Tuesday morning. We've just shut down the Red Sea to oil. That is going to be inflationary, folks. But last week, we have Jerome Powell come out and basically wave the white flag and go, inflation's all over. We're done. This has been the same thing that they've been saying for 2 weeks now, 3 weeks if you go back into the FOMC meetings of November. It's going to end the same way. And why? We deserve it. Because what we're doing is we are front running the Fed. The Federal Reserve Bank is coming out and they're saying, hey, listen, we think that we've got inflation under control. And the market is taking that as a green light to spend and buy and buy and buy. And they have rallied. They've run the market up to, we are at all-time highs on the S&P 500. We are closing in on the NASDAQ 100. This is rocket ships right now. We've talked about this crazy overt market for the last couple months, last month and a half. This has been an exponential rally. But we've also talked about what happens in these elastic markets and how when we get these euphoric runs, they snap back. They are an elastic band. And there's lots of money made right now. And there's lots of money sitting in the bond market waiting to jump into treasuries and stocks. But I don't see it happening. And what my concern is that once we get through Christmas, once we realize that there's still going to be some lingering inflation out there, when people start looking around and go, I'm not seeing deflation in my expenditure. And there's a difference there, right? When you go to the grocery store and something cost you $1 2 years ago, and it went up to $1.25, right? We're not looking to see it go back to $1. We're just looking to not see it go to $1.30. And everything that we have going on right now, this issue that's happened over the weekend in Yemen, where we have a new terrorist organization, I'm going to go out on a limb and call them that is shutting down the ports where oil out of Saudi Arabia and the Middle East is being rerouted around Africa to get to Europe, because the Red Sea is completely shut down now because they bombed and pirated these oil vessels. This is not going to end well. That's going to be inflationary. And then we have Goolsbee. We have all of these Fed chair officials that are coming out in the last 48 hours. They're like, hey, whoa, pump the brakes here. We aren't cutting right away. We're not sure if March is going to be a cut. But the Fed came out and they did their little dot plot that showed all of their expected rates and their revisions over what the interest rates will be over the next 3 years. And they are counting on massive cuts. They're massively discounting where the rates are now. But will that last? Will that turn out? They're counting right now a 90% likelihood on rate cuts by March. By March. We are a week away from January. February, March. 2.5, 3 months, they are talking about starting to cut rates. What if things perk up a little bit in the Middle East? What if inflation isn't dead? What if we have a geopolitical crisis? Or even crazier, what if they have to cut rates because the market in and of itself is in a worse situation than they expected? What if the economy has been damaged by the cuts, by the interest rate hikes already? They're always late. This has never landed. You cannot watch that 5-minute clip in the beginning of this interlude and not say that could be played today. It could literally be shown this morning. And I think this brings us to a great opportunity to chat with a good buddy of mine. And, we've got lots of family. We got lots of friends out there that are trying to figure out how to plan. What's next? What is mortgage rates going to be doing? How to buy a house? How to buy multifamily? All of these things. And I think that goes completely into what we're talking. Hey, folks, and welcome to another fantastic episode of Financial Fitness. And I'm your host, as always, Patrick. And tonight, we've got a very special guest, one of our fan favorites here on Soaring Prophets Media, the one, the only, Mr. James. How are you doing, pal?
Hi. I just want to say I've been a fan since the show started. And I am first-time caller,
long-time listener,
lifetime fan. And I am so happy to be here, especially today, mostly because, one, financially speaking, in the stock market, I feel like I'm being attacked by sharks. And two, I was at the bank today, and I have to renew my mortgage. And now I had a very good rate for my mortgage, and now I have a double of that. And I'm not a big fan. And so who better to talk to than Financial Fitness with Pat Ahern? Yeah, you.
Wow. Well, first of all, you are bringing up a ton of really good things, and it is a question and a concern of everyone around the world right now. So those of you in the United States, you have to understand our situation here in Canada and as well what's going on with Europe. So we take termed mortgages. So we choose an interest rate. Well, first of all, we choose a lender. Then we choose an interest rate. Then we have a term that is set out, and then we have an amortization period, the length of the mortgage. So everyone, you folks down in the States, you'll pick a 30-year mortgage. You walk in, you negotiate your terms on that. You've got a basic understanding of what that's going to look like. And then you can set it and forget it. Theoretically, you might have
Forever,
a
I hear.
35-year mortgage where you never touch again. Up here in Canada, the same as in Europe, we tend to go through usually 2 to 5 year on terms of our mortgage. We keep the amortization at that 30 years, or we can reduce as we renegotiate. But what it's done is it's allowed Canadian lenders and European lenders to leverage their purchases of their properties and refinance. So in Canada, we have unfortunately used the Bank of Canada and our lending strategies as our own personal banking. So a lot of people found themselves 10, 15 years ago. I promised we were going to get to James, but I want to give some background.
Okay.
We saw a lot of people that were buying homes, quite literally under 10 years ago, where they were paying, $100,000, $150,000 for. Now they're running up into that $6, $7, $8, $9, even $1 million for these properties, right? So that's a 10x. That is almost 100% per year if you think of the macroeconomic scale of what that is.
Which is amazing if you own a home.
That's if you own a home, right?
Yeah. Yeah.
So what we're seeing now is that our rates have went from the COVID rates in and around that 2%. And now, James, what did the bank tell you today?
So I'm at, so if I were to sign today, it would be 7.2 would be the percent.
So you're looking at a 5% differential in rate.
Which adds $500, which in the United States would that be 800, 900?
Other way,
300. Sorry. Yeah, that's right. So it'd be $500 to my monthly rate because I pay weekly.
So is that $500 a week or is that $1,000 a month?
So it's $500 a month because I pay every week.
Okay.
So in the end, it works out to be about $500 a month that they're adding to my mortgage. So that's all of my groceries, all taken up by this new mortgage bill if I sign. So I do have other options. Yeah. So the great thing about this system is that I'm not locked in for life. If I were, say, to buy a house today, I'd be locked in for life at a 7.2. But that's not the case here. I can lock in for 3 years and with a variable, like you said. So maybe explain a variable because that's what I'm thinking of doing, locking in for 3 years with a variable rate. And then I'm not stuck with this high interest rate for the rest of my life.
Yeah. Well, there's so many different products out there, and that's, we should really get a mortgage specialist on to talk about the intricacies of that. But so the primary options that are out there is you have a fixed rate, a variable rate, open and closed mortgages, and then the length of time that we're going to amortize those products for you, right? So again, I'm a lending professional. I am not a mortgage specialist. But I got a couple $1 million worth of real estate, and the bank likes when I make payments. So they work with me, they talk with me. We have a process that we go through, and I've learned how to kind of negotiate some of these processes. So where James finds himself right now, like he said, is that if he was purchasing a product right now, a new house, and he was trying to lock in that rate, why would you? We're at the top of these rates. So what I'm suggesting to him is to look at variable rated products. So he's going to go to his bank, he's going to go to his credit union, he's going to go to his broker, a mortgage broker, and say, this is my situation. This is the amount of dollars that I need out, whether he wants to refinance, which not a great time, but we can touch on that a little bit as well. Because I know you've got some kids that are in a position where they're talking about buying.
That was going to be my next question.
Time, grandkids, well, I think it's grandpuppy right now is kind of the stage you're in.
cute little grand furry daughter, I guess.
I haven't seen all the photos out of the wallet yet, folks, but that probably is coming.
She's amazingly stubborn, which makes me so happy because my son was the most stubborn child ever. Love him.
Karma.
He's stubborn, and now his little puppy's super stubborn too.
That's it.
They take her for drags. Anyway, off
Not
topic.
walks, drags.
But yeah, no, I do want to. That would be my next question: is to roll some money out of there so that I can use it to like build that platform that we were talking about. And we may need to wait for that. But first, let's talk about the variable because that's where I'm at. I can shop around and go to many banks. I can go to a broker, but first I have to understand what a variable rate is.
So a variable rate is going to be market dependent. Okay. So as we've seen, you folks, you profiteers out there that have been watching the financial fitness here, we've been talking about bond rates, and we have watched an unfurling of a level that we like historically unprecedented, other than the 70s. And I'm going to give a slight asterisk to that. We saw rates drop by 1 whole percentage point, 100 basis points once before in the 70s, before the Paul Volcker 18, 19, 20% rates. And that was in the same approximate amount of time. Now, theoretically, we went from 18, 19%, dropped 1 whole percent in a month. We were at 5. We were at 5% rates, and we dropped 1 whole. We have dropped 25% in a month. It's gone crazy. Look at this guy. Who is this? Is this what it's like to have a producer?
This is what it's like to have a producer that's active.
Look at
so
this
here
guy.
We are. I don't know if you can see that.
So what we're doing here, so the variable rates follow the market. So as we see, we've talked a lot about the 10-year, we've talked about the 2-year. The 2-year is what Jerome Powell is focusing on in the United States. We are the United States little hat up here in Canada. We are going to follow suit. We are doing all the same things. We did it 1 month earlier in our pause. We will likely end up dropping rates in around the February, March range. We are right now in a position where, why are they dropping rates though? What's happening in the market to drop 25% of your total bond yield in one, let's say 45-day period? It's been wild. But what happens is when you have a variable rate mortgage, it's following that. We call that prime. That is the prime rate of lending. Okay. So right now you have different institutions that will lend at different rates. You'll have prime plus a quarter, prime plus 1, prime plus 2. These institutions are borrowing the money from the Bank of Canada. They are taking a profit point on that, lending you that product, and it's going up and down with the market. Okay. So in Canada right now, we are looking at about a 5.25%, 5.5%. Sorry, in the United States, we're 5.25%, 5.5%. In Canada, we are just a little bit higher than that. So when we turn that around, we end up prime 1.5%, 2%, or 2 points that put us around that 7.25% right now. So what we've got to be cognizant of is that if we are at the top of rates, okay, if you are signing up for your mortgage renewals, you don't want to sign up at 7, 7.5%, 8% for 5 years and lock yourself in on that rate. You want to be able to ride the benefits of that quantitative easing that's going to be coming, right? So that's if you believe that we've defeated inflation. That's if you believe that the Fed is done tightening. If you believe that the world is now going to go back to quantitative easing, we are done the cycle. This is where over the last 30 days, we have seen Jerome Powell come up with his speech. Famously, November, I think 2nd was the speech where he comes out and he is all but saying we are done tightening. My question, though, and the concern that I bring up is that why are they done tightening? And the only thing I can come up is that they are concerned about a cataclysmic event in the market. We are seeing unemployment remaining high. We are seeing consumers stay resilient. We are seeing all of these trends remain. However, they are pulling we did it really kind of early in my experience. They're calling it the soft landing. The alternative to that is a fixed rate. You walk in, you negotiate your fixed rate for the term that you want, with the amortization period that you want, and you know every month what your payment's going to be.
And
versus,
in this case, my fixed rate will be slightly less than prime.
Right.
So it will not be the 7.2. I think it was 6 point something.
So the reason why banks are offering you that now is that they want you stuck there.
Yes.
So they want you at 6. You said 6.9?
Something like that. Yes.
Let's say 6.9.
Yeah.
Right now, what the feds are pricing in is five reductions in 2024 and into 2025. That is at minimum, that is 1.25% by this time next year. Okay. That is, again, wild quantitative loosening. That is sprinkling crack on the market and going have ham. They are seeing something. They're concerned about something. Okay. We quantitatively ease. We provide stimulus to the market when we're not seeing growth. We rein in growth when we see inflation. It's a cycle, right? I'm going to be honest with you. James and I, like the last month and a half, I have been reamed. This because we have seen the market rotate from a tightening cycle into this loosening cycle with truly, and I mean this, truly, none of the boots on the ground information being tangible, right?
No.
We look at consumer debt, all-time highs. We look at foreclosures on auto loans, all-time highs. We look at the consumer confidence out of the Michigan Sentiment Report, all-time lows. This is not an all-time high market, but likely this week, we are going to see, we just saw the Dow Jones Industrial Average hit an all-time high. We're likely going to see the NASDAQ this week hit an all-time high. And I'm asking you to look around. Look at your life. Look at your neighbors. Tell me. And James and I are pretty comfortable dudes.
Yep.
We're not hand to mouth on this too often.
No.
But this is a situation
Well, we both
where it's
just
really
got hammered by the market, and we're still like just sitting here kind of smiling.
Yeah,
So,
like we're talking multiple six figures here.
We're not dying or anything, but it is concerning because for me, it's concerning because I look around, the homeless population has never been bigger. Right. The crisis of like they keep on saying that there's a job market increase. People are being laid off in like key lifetime jobs are being laid off.
Well, are you hiring?
How is
at
there
Apple?
an increase in jobs? I don't understand.
Are you hiring at Apple?
I am not hiring at
Doesn't he look like
making
Steve
a joke
Jobs
about my
today?
shirt?
Look at that black shirt. You look fantastic, pal.
Well, thank you. Yeah. No, we are not hiring at Apple at this time. We find it's fiscally responsible for us to lay off individuals who don't quite fit our structure anymore because we're in a restructuring phase to streamline our next move.
All right, there was. I'll do the finance talk. You just keep inventing all the background stuff. But
okay.
No, it to me, this is lunacy. And there's an old adage in the market that the market can stay irrational longer than you can stay solvent. And I think it's boding very well for a lot of investors right now. What we have saw, and this is going back to, this week's financial fitness last week, because we filmed this a few days earlier. But when you see short covering and we talk about short squeezes, and we saw it in the market when we talked about, AMC, we saw it with the GameStop, right. We saw these powerful mechanical gamma squeezes of the market. They're not to be messed around with. The problem is that if, and these are all huge ifs, if the bond market drops low enough, fast enough, we're going to see trillions of dollars rotate out of bonds into the stock market because they're like, I got it. The stock market's going to go up 50% next year. This is where we catch retail with their pants down. The rug gets pulled out and we end up with a 30, 40, 50% down year next year. Every market, historically, the rubber band pulls back. It either breaks and you have a massive crash, or it snaps back before expanding again. We do not see these runs like this. Parabolic, straight up, hockey stick, Connor McDavid stick, like whatever you want to call these. We do not see these last. The concern for homeowners like James.
That's where I'm going. Yeah.
The concern
So then,
for homeowners like James.
Me locking in.
Yep.
Chances are those interest rates aren't going to go any higher. Now, they could.
Yep.
They definitely could. So if I lock in and the interest rates go higher, I win.
No.
If I lock in and they go down.
I apologize. I mistook that. Yes.
Yeah. If I lock in and they go down, I lose.
Yes.
There is a like 90% chance they're going to go down. So it makes no sense not to do a variable.
Yes.
So here we are in a variable.
So we talked a little bit about this prior. So what are my concerns that, you know, that I articulated to you earlier about trying to ride all the way down? So there's a bunch of them. We are now into an inflationary cycle, right? Green energy is going to be massively inflationary to our society, right? We're seeing that in our taxes.
Yes.
It's going to be inflationary. Okay. You're going to be onshoring resources, right? Manufacturing needs to come back to North America. I'm not saying everything, but if we're going to fight with China and every 6 to 8 to 12 months, they're going to go and shoot a bomb over Taiwan, we're going to stop doing business with them in the same way that we have for 40 years. So that is onshoring manufacturing. Well, that means they got to buy land. They have to have construction workers to build the factories. They have to have laborers to build the products. They have to buy cotton because you're making t-shirts here now. You got to buy copper because that's going into the wire. All of these are inflationary things. Inflation demands a reaction, which demands price increases. Okay. So what I think we're in right now as far as homeowners, and this is the same in the States as it is in Canada, anywhere in the world, we are going to have a circle of look at what everyone did going into the election.
Yes.
This is going to be a political handshake moving
Right.
into this next 8 to 12 months. Look what we did. The Biden administration solved the financial crisis that was inflation, right? Yeah. And then all of a sudden, you're going to see it all roar back over the next 5 years because we are in that cycle now. The big one is that the boomers who have all of the wealth are going to be moving their money out of risk into safe bond assets, which will initially drop down the prices, but will restrain liquidity. Okay. So what that means is, James, you're a retired guy. You own a couple properties. Do you want to take and roll the dice every week on Tesla?
Not anymore. No.
That's it.
I just want to hold on to what I got and maybe make a little bit extra.
Right.
Yeah.
So if I can promise you 4, 5, 6% guaranteed, you're my best buddy, right?
Sold.
Okay.
That'll get me through. That'll get me my cat food and my dinner for every day for a week.
That's it.
In. Sign
but
me up.
Now your son, right, is requiring cheap money to get a house at $1 million in our area.
Yes.
There's no cheap money anymore.
No.
Because you want your 6%, you greedy old man.
That's right.
Right. So what's happening is that as these people cycle out of risk assets, because that's where business and growth come from. You have to take risk, you get a return, and that business grows. You cycle into bonds and different low yielding products.
Okay.
These are all going to be inflationary over time. That is going to be the next cycle that we go into. Okay.
Just so everyone's aware, I'm not a boomer. I am a Gen Xer. But that leads me into my next question, which is, so my son, like you said, is looking at, he makes a lot of money. So does his wife, girlfriend. And they are looking at buying a house. I did hook you guys up. So you have had that chat.
Yep.
But originally what I was thinking of doing was taking out 40 grand and 50 grand and handing it to them at a very bad time. But I was going to take that risk because I love my son.
Right.
Now you came up with some other options for them. So that I wouldn't do that because right now me taking 50 grand out, probably not a good reason. So maybe talk a little bit about that. As a dad, what should I do? Because I do have the money. I could take 50 grand out of my house, hand it to them. I could survive with that. No problem at all. But why not?
Well, so again, when you're borrowing at 2%, $50,000 is free money. When
Yeah.
you're borrowing it at 7, maybe an increase in rates before we're all done, call it 7.5, for ballparking it. $50,000 is not an unsequential amount of money at that point. So you have to look to the want, the need, and then is it something that they are truly incentivized to do? So when I talked with your son, one of the things that I broke down is, okay, so first of all, are they looking for their forever home? Are they looking for an investment? What stage are they in? And they're in their early 20s. They're looking for something that, although they'd like the mansion up on the hill, they're smart. They've been raised well. That I'm explaining to them that right now you're better to go buy a multifamily, buy a 3-4plex unit, use the rent as an asset to get you in the door, and you will never have a mortgage payment the rest of your life. And you'll have an asset that will be worth millions forever.
Yep.
So when we talked about that, when we talked about how to first time home buy a multifamily property at 5%, they have more than enough to cover that.
Yes.
So dad, being a hell of a guy that he is better to go buy furniture for the house or go spend $20,000 on renovating a bathroom, or, hey, I'll help you with the refinancing so that you can add 10 more units to this property because you bought it smart. Those are all the options that I would suggest in his situation. The $50,000 cash in your son's situation is not a big enough help for where they are because they're financially stable and settled. They've got fantastic jobs. They're very smart financially. They're not crazy out there going wild. They're in a position to do that. So the $50,000 to you in that situation is better for a value added position.
Yeah.
And they completely understood that. They were like, hey, we haven't really thought about the multifamily aspect. We can buy a first time home buyer, 5%, go buy a duplex, a triplex here in Canada, in Ontario.
Yeah.
We can roll that over. And then when we buy our dream home for $1.5 to $2 million, 5 years down the road, we don't have a mortgage payment because the rent's paying for our house.
Yeah.
So what you're doing is you're using equity that, they've built, their sweat equity. You would be using equity from your primary residence in this case, or I don't know if you're thinking of doing something else, but you would be using that equity to then purchase an asset, an appreciating asset. Don't buy the Lambo. Don't buy the dream home now. Buy the asset that will accumulate in value, giving cash flow that pays for the dream car and the dream home and all that stuff. These are basic economic fundamentals. And the earlier you understand them at 23, 24, 25 years old, these kids are on a path now where they're set for life. So,
absolutely. They're both doing really well. And now that they have the financial sense to move forward in a way that they, that you showed them, I don't, it's a no brainer. They're going to be fine, especially when they have platforms to jump off for me and they know a lot of people. So I think it's
Uncle Pat.
Exactly. Yeah. Like, so when we inherit your money, we'll be set.
Once old Jerome Powell cuts me a check for what he stole from me this last month, I'm hoping that somebody delivers that sumbitch some coal or something. I don't know. Somebody's gonna, but
he really has been handing it to us. Like every time he comes,
it's been a bad 40 days.
It's not been good.
Yeah.
So Powell.
Yeah.
Cool.
Jerome, we know where you live, pal. We're coming for you. Shut the door.
Well, brother, I'm not in the background right now sending you little messages of love saying it's time to wrap it up. But guess what?
We're there. Well, folks, again, I want to thank you and my special guest, good buddy of mine. And even when I'm cranky, he still loves me enough to come on the show wearing his Tron shirt, which I love it, man. It is. I'm giving you a hard time about the Steve Jobs and that you're in the future, but you look good. You clean up all right.
You love it.
I do. It looks good. I actually, I'm not going to lie. I Googled the shirts, the brands when we were on earlier. I'm like, that's not bad. I like it. So, folks, thank you so much for joining us. Usually I have our guests, sign off with words of wisdom. So I'm going to ask James. James, financially, what are your words of wisdoms for our guest today?
I have so many words of wisdom financially. No, so right now it's Christmas time coming up.